Chapter 12, Differential Analysis. Hello all. Chapter 12 is all about differential analysis. Simply put, differential analysis is all about analyzing the different costs and revenue amounts that result from alternative solutions to a particular problem. As a future business professional, you will make decisions every day. Every decision involves choosing from among at least two alternatives. Decision making is all about looking at alternatives and making choices which will create value for the firm. The must-know from this chapter includes two items. One, how to determine what is relevant to the decision-making process, and two, how to make decisions. Decisions relating to adding or dropping product lines in other business segments, decisions relating to make or buy decisions, decisions relating to taking on special orders, decisions relating to utilization of a constrained resource, and finally, decisions relating to sell or process further decisions. Throughout this chapter, we'll look at each of these decision types, and you'll become familiar with the processes used in coming to a solution. Decision making is a six-step process. First, identify alternatives. Second, distinguish between relevant and irrelevant costs and benefits. Third, identify sunk costs. Fourth, identify future costs and benefits that do not differ between alternatives. Fifth, identify any opportunity costs. And sixth, perform a differential analysis. Once the process is complete, a good manager will make a decision that passes the cost-benefit test. That is, they'll select the alternative that produces a financial advantage. Financial advantage is a decision where the differential benefits exceed the differential cost, and as a result, create value for the company itself. The first rule of decision making is to focus on relevant costs and revenues and ignore everything else. Relevant revenues or costs in a given situation are future revenues or costs that differ depending on the alternative course of action selected. Differential revenue is the difference in revenues between two alternatives. Differential cost or expense is the difference between the amounts of relevant costs for two alternatives. Differential revenues and differential costs are always relevant. Differential cost may also be referred to as incremental cost. Now let's look at opportunity cost. Opportunity costs are always relevant in choosing between alternatives as well. An opportunity cost is a potential benefit that is foregone by not following the next best alternative course of action. These costs are not actual cash outlays and are not recorded in the formal accounts of an organization. Another term you need to be familiar with are sunk costs. Sunk costs are past costs. They're never relevant to a decision making because they have already been incurred. Therefore, these costs cannot be changed no matter what alternative is selected. Finally, we can talk about future costs that do not differ between alternatives. Like sunk costs, these types of costs are irrelevant and may be ignored since they affect both alternatives similarly. Managers will also discuss costs in terms of being avoidable and unavoidable. Avoidable costs are costs that may be eliminated in its totality or in part by choosing one alternative over the other. Unavoidable costs, by definition, must be incurred. Avoidable costs are always relevant costs, while unavoidable costs are not relevant costs. Now let's talk about some rules of thumb. For certain decisions, revenues do not differ between alternatives. Under those circumstances, management should select the alternative with the least cost. In other situations, costs do not differ between alternatives. Accordingly, management should select the alternative that results in the largest revenue. Many times, both future costs and revenues differ between alternatives. In these situations, the management should select the alternative that results in the greatest possible difference between future revenues and expenses. When analyzing alternatives, managers must choose between using a total cost or differential cost approach. The total cost approach is also called the comparative statement approach because it compares the income statements of each alternative separately. The option generating the highest earnings or financial advantage is chosen. The differential or incremental approach calculates the difference between the additional revenues and the additional costs of each alternative and selects the option which contributes the most value to the firm. Using the differential approach is desirable for two reasons. One, only rarely will enough information be available to prepare a detailed income statement for both alternatives. And two, mingling irrelevant costs with relevant costs may cause confusion and distract attention away from the information that is really critical to the decision. Let's now turn our focus to decision choices. First, let's look at adding or dropping product lines and other business segments. In this scenario, part of the company is struggling. Overall, all may be well, but either a product line or a business segment is not performing up to expectations. The question to be answered is, should we get rid of the struggling component or not? The decision to be made is, do we drop or not drop the product line or business segment? For these types of decisions, the presentation will use a comparative format showing the keep versus drop impact side by side. The incremental analysis will focus on the lost contribution margin and avoidable fixed costs, as changes in these areas will affect the net operating income. The decision rule here will be if the lost contribution margin is greater than the avoidable fixed cost reductions, then dropping the product line or business segment will decrease profits. So we won't drop. If, on the other hand, lost contribution margin is less than the avoidable fixed cost reductions, then dropping the product line or business segment will increase profits. And our conclusion will be to drop. The second decision choice that we have is to make or buy. When a company is involved in more than one activity in the entire value chain, it is vertically integrated. A decision to carry out one of the activities in the value chain internally rather than to buy externally from a supplier is called a make or buy decision. In this case, we're deciding on whether we want to make something ourselves or do we want to buy it from someone else. The decision to be made is, do we make it or do we buy it? The presentation will use a comparative format showing the make or buy impacts side by side. The decision rule here is if the relevant costs to make the product are less than the cost to buy, then we'll make the product. On the other hand, if the relevant costs to make the product are greater than the cost to buy, then we'll buy the product. A third type of decision involves special orders. A special order is a one-time order that's not considered part of the company's normal ongoing business. In this case, we've been approached by a customer in an area not normally served. The customer offers to buy products or services at a special price and is typically willing to purchase a large quantity. The decision to be made is, do we take the special order or don't take the special order? It's a yes or no decision. When analyzing a special order, only incremental costs and benefits are relevant. The focus is on the contribution margin improvement from the special order, as fixed costs will not change if there's sufficient capacity. The decision rule is, if the incremental revenue is greater than the additional costs, income will increase, and yes, we'll do the deal. On the other hand, if the incremental revenue is less than the additional cost, income will decrease and there'll be no deal. The fourth type of decision deals with the utilization of constrained resources. Here, companies are forced to make volume trade-off decisions when they do not have enough capacity to produce all of the products and sales volumes demanded by their customers. Because something is hindering our ability to meet our customer demand, we are said to have a constraint or a bottleneck. In this case, we have a number of products, but we have limited resources. Demand for our product exceeds our ability to supply all needs due to resource constraints. In these situations, companies must trade off or sacrifice production of some products in favor of others in an effort to maximize profits. Management's goal will be to sell the product which make the optimum use of constrained resources. Fixed costs are usually unaffected in these situations, so the product mix that maximizes the company's total contribution margin should ordinarily be selected. A company should not necessarily promote those products that have the highest per unit contribution margin. Rather, total contribution margin will be maximized by promoting those products or accepting those orders that provide the highest contribution margin in relation to the constraining resource. So the analysis requires a variable costing income statement with a focus on the contribution margin per constrained resource used. The decision rule is to select the product with the highest contribution margin per constrained resource. A simple scarce resource allocation decision involves the following steps. First, you calculate the contribution margin per unit of the scarce resource from each product. Second, rank the products in order of decreasing contribution margin per unit of scarce resource. Third, estimate the number of units of each product which can be sold. And fourth, allocate the scarce resource first to the product with the highest contribution margin per unit of scarce resource, then to the product with the next highest contribution per unit of scarce resource, and so on. The fifth decision strategy is sell or process further. These decisions are mainly applicable to farms and producers of natural resources. In this case, two or more products, known as joint products, are produced from a single raw material input. The point in the manufacturing process where the joint products can be recognized as separate products is called the split-off point. Some of the joint products may be in final form, ready for sale, while others may be processed further. In such cases, managers have to decide whether to sell the unfinished goods at split-off point or to process them further. Such a decision is known as a sell or process further decision, and like all business decisions, it must be made so as to maximize the value of the business. When making the decision to sell as is or process further, joint costs associated with producing the raw product should be disregarded from the decision-making process, as joint costs are irrelevant in decisions regarding what to do with the product from the split-off point forward. For these decisions, the incremental or differential approach works best, as management must consider: one, how much revenue the company will generate by selling the product unprocessed; two, how much revenue will be generated by processing the product further; and three, how much additional cost will be generated to process the product further. The decision rule in this case is that it is profitable to continue processing a joint product after the split-off point, so long as the incremental revenue from such processing exceeds the incremental processing cost incurred after the split-off point. If incremental revenue is greater than incremental cost, then process further. If incremental revenue is less than incremental cost, then stop. Differential analysis is an excellent approach to the decision-making process. It's important that you realize, however, that the focus is only on quantitative analysis with little thought given to qualitative considerations. Ignoring the impact on social programs, employee morale, quality of life, customer perceptions, market perceptions, and so on can make what looks good on a spreadsheet file a bad decision for the company. Care must be taken to make sure that assumptions are not oversimplified and that they are consistent with the overall vision of the firm. Well, that takes care of Chapter 12, Differential Analysis. A lot of good decision-making stuff in this chapter. Thanks for watching the video. Now it's time to practice. Good luck.